Namaste. Welcome to Zudella. Everyone, whether a student, working adult, or many retired adults in India, have no idea about share market, and there is nothing to worry. Today in this video we will discuss: what is stock market? Is it risky? Why one should start at early age? And why no one should shy away from stocks. So let's start. What is stock market? Stock market is a virtual place where companies requiring funds for their business activities list their shares, which are small units of ownership in their business, and investors give capital to the company in exchange of the shares. This process of fundraising is called the initial public offering. There are stock exchanges where shares are listed. What are stock exchanges? India. India has mainly two exchanges that are National Stock Exchange and Bombay Stock Exchange. Fun fact: BSE is also a listed company and one can buy its shares. Brokers act as a medium between shareholders and stock exchanges. Whether you make money or lose money in market, the brokers are always making money. So understanding the process, potential investors need to choose a broker to open a demat account to buy shares listed on stock exchanges. Are stock market risky? Everything depends on how you approach stock market and what are your expectations from it. Stock market can be approached mainly either for investing or trading. Investing can be used as a medium for wealth creation. Wealth can be created through investing, where thousands of rupees can grow to be crores. Stating examples of wealth creation through investing are: 10,000 rupees invested in Wipro Limited in 1980 would be 700 crores. 1 lakh rupees invested in Bajaj Finance in 2009 would be 3.8 crores. Investing creates largest sum of money, but it requires patience and long-term horizon. And let me bring to your knowledge that investing is boring. Coming next to trading and speculation. Trading stocks is basically buying and selling shares within few minutes, days, weeks, or even months with a motive of earning profits. Trading stocks or derivatives can be too dangerous for a beginner as well as unexperienced folk. The reason being that nobody knows how the stock price will move in short term. In trading there is at most possibility that the trader can lose 100% of their capital. Even in futures and options, if you are wrong with your prediction, you can lose all of your capital within a single trading day. I am not here to make things seem scary, but this are obvious possibility. For trading, you need to have expertise and experience with technical analysis, probability distribution. That is the reason trading in stock and derivatives is not suggested to a beginner. One can develop the expertise too by reading books, learning skills relating to trading, and lately practice is all it takes. It's been said in market that stock market is a place where people with money earns experience, and people with experience makes money. Let me tell you a story. A story of two friends who were at the same age of 20 years. One was Kabir and his friend was Alex. Alex was from a rich family, and he had acquired wealth and a family business. Whereas Kabir was from a middle-class family, and had no acquired wealth like Alex. Alex was a person of luxury, and had a belief that life is to be enjoyed, and he lacked vision for the wealth he just acquired. He spent huge piles of money on vacations, cruise and other luxuries. Kabir was a passionate man with humble beginnings. He knew how investing can give him freedom. He had a vision and wanted to establish an empire of his own. With whatever money Kabir has, he had principles. He would invest 25% of his earnings at the starting itself. Spend 10% on self-improvement. He lived a frugal and simple life to achieve his dream empire. Alex lived the same life of luxuries, and within 15 years his wealth came to an end. He was in search of job fulfilling his needs, whereas Kabir worked for his dream day and night. And, with a hard and struggling life, in 15 years, Kabir had built a business, which was growing at 24% a year. Kabir started with a sum of 1 million rupees, and in a time of 30 years, with a growth of 24% annually, Kabir had 100 crores and an empire which was on autopilot mode from now. While in the coming time, Alex filed for bankruptcy, whereas Kabir had all the freedom he ever wished for. Moral of the story: a fool and his money is just a big party. Being an Indian, I see a lot of investing opportunities here in India. The rural India is yet to taste the growth, and the rural rockets are yet to ignite and take the flight. Talking about the scenario in India, the general public or the middle-class Indians think of stock market as a gamble market. And many orthodox family doesn't encourage investing in stocks. Indians shy away from stock market, here in India. Taking statistical data in consideration, only 2% of the Indian population has invested their saving in stock market. Majority of the savings of Indians are invested in real estate, which can be divided into property and agricultural land, that is farms. Majority of Indians are occupied as farmers, and if we talk about their net worth, it's the farms they own. The most sacred investment is gold. We Indian have a festival on which we specifically intend to buy gold and worship our assets in Hinduism. The last conventional form of investment is bank savings and fixed securities, in which many keep money for general investments. Fun fact: we know that only 2% of Indians invest in stocks, but wealth amounting to $2,300 billion is because of the Indian stock market. The same amount when converted to rupees will be 170 lakhs crores rupees. We discussed how none of the convention asset classes, and the reason why savings should be invested in stocks. Investing in stock market can give best returns in long term. Stocks are basically businesses for sale, and equity investing in long term creates wealth, which gives financial freedom. Many Indians are that much behind safety of their money that they end up getting no returns and growth of the capital. People invest funds in bank fixed deposits in India, which give returns ranging from 3% to 6.5% per annum, whereas inflation rate currently in India is 4.04%. What is inflation? Inflation is the rate at which prices of general necessity increases. So observing the scenario and adjusting return of bank fixed deposit against inflation, the net return on bank securities will be 2.5% maximum. Whereas many listed companies in stock market itself paid dividend ranging from 2% to 4.5% per annum. Dividend are the profits the companies distribute to their shareholders. Thus dividend alone itself is better than fixed deposits, leaving aside the returns of stocks. Talking about the shining metal, gold as an investment. Gold has been the safest investment and the best hedging instrument against inflation. What is hedging? Hedging is a method of protecting our investment if the prices of the asset you invest go against your prediction. Thus hedging helps in minimizing the losses. But going into history, we can conclude that the returns given by gold as an investment are not equal to the returns given by Indian stock market. We Indians love real estate, but observing the prices of real estate since demonetization happening have been in serious trouble, and the prices of real estate since are in downtrend, and various construction companies in India are facing cash crisis. Real estate as an investment requires large amount of money like 1 million rupees, and an average Indian can't afford to invest that much. Talking about minimum amount to invest in stocks is as low as the price of 1 shares. Many Indians want to invest in stocks, much they don't know much about markets. They don't want to analysis and give much time to the homework required, and they have less risk appetite but want returns higher than fixed incomes. There is a way. Take the advice of the legend himself, Warren Buffett, who started from zero and currently has a net worth of $84 billion. Here is the advice. Start investing on a regular basis in index funds. Buy large quantity of index funds after the stock market crashes. But remember, to stay long term, they have given returns much better than other assets classes, and are less risky in long term. Now you might have a question. What are index funds? Index funds are funds that consist a group of shares, which are part of Sensex and Nifty 50. Thank you for watching the video. If you learned something from the video, like and share the video, and subscribe to the channel for getting alert regarding new videos in the field of markets and finance.